Good day, folks. Welcome to step 6. We now take a look at cash flow. And when we look at cash flow, most entrepreneurs believe that profit is what's more important to the enterprise. But profit is secondary. The most important thing is cash flow. Cash flow matters most. Now, this comes from Peter Drucker, who you know is a management scientist. And he was an economist and a psychologist and focused on behavioral aspects. But in this quote, he actually talks about cash. Cash is king. It's the lifeblood of the organization. So when we look at a company, we have to understand its capacity to generate cash. So that's what this is does a company generate cash? So what we start out with is within the 10K, there's a very detailed cash flow statement. But to help us begin our analytical process, we need to create a summary cash flow. We're going to combine information so that we can focus on the key issues. Now, when we look, cash comes from 3 different places. Cash comes from cash flow from operations, investing activities, and financing activities. Understanding the details of both, where money comes from, helps us draw certain conclusions. We want to see cash flow from operations as being positive. Now, we can start out, net income isn't always cash flow from operations. There's different things that go into it. So the starting point for cash flow from operations is net income. Then we have to adjust for non-cash expenditures or income. The best example is depreciation. Since we already bought the equipment or the property years ago in the past, we're depreciating it over its life. So we have a difference between the accounting recognition of when the cash went out than we do from a usefulness of the equipment. Then changes in working capital. We got to have working capital, but with the working capital, it's going to either increase or decrease. And that is really, we're using that to fund operations, or it's providing funding to operations. So we come down to this big number right here, total cash flow from operations. But if we look at it in these 3 and bunch, if you will, the things into these 2 categories, we'll have a very much a cleaner view, so we know where we need to go. In part of the analysis is we don't want to get lost in the weeds, but we want to be able to know when we need to go into the weeds to find out what it is. Next piece is cash flow from investing activities. Now this includes capital expenditures and acquisitions. They should all be in one. Certain other non-operating incomes. In most cases, that's investment securities, and what they are often reported on a gross basis. How many did they buy? How many did they sell? Now, they're using investment securities because they have excess cash and are trying to generate a return. Remember, all companies don't have this. The other thing that's non-operating is if you sell a piece of property or equipment. That gain or loss isn't from operations, it's from the results of investing. So think about investing as building the company. Okay. Next piece that we look at is cash flow from financing activities. And again, we're going to see a lot of things that are underneath all of this, but we want to look at it in 2 ways. What does it relate to debt? New loans, borrowings, and repayments. And if you look at statements, they're going to report it gross. How many new borrowings and how many repayments. So that it's not a net number, but we can take, for analytical purposes, we can take the total number. Now we're looking at it for a different reason than a lender may look at it. Then we look at equity. What are the transactions that occurred from equity? And then there's other items. And let me just show you an example, and that gives us the cash at the end of the period. So here we start out, as you can see, I've taken and put this into smaller numbers, and we could see with Steel Dynamics that they generated cash provided by operations, $1.4 billion. Now, what did they use that money for? So if you can start out and ask your question, okay, they provided the money, what did they use it for? Well, they used it for capital expenditures, acquisitions, and investments. So they used, of that $1.4 billion, they used $895 million for future growth of the company. Then, what did they use the rest for? They spent $720 million on dividends and purchase of treasury stock, and a small amount on paying back debt. So when we start with this $1 billion is where they started, and they ended up at 834, we know that cash flow from operations was strong, and it enabled them to do all of their capital expenditures and acquisitions and return money to the shareholders. So this is what we tend to like to see. We don't want to see this number being negative. Okay, so if we go back here to 2014, we can see that the $617 million provided by operations didn't cover that which used for investing. So we can see they borrowed money to fund that acquisition. So this is going to give us a lot of clues as to what's going on with the cash flow. Remember, cash is king. That's what's most important. So next thing we want to look at, if we know that, then once understand that, is free cash flow. Okay? And free cash flow is the cash available for distribution to investors. And in this sense, we look at investors as stockholders and debt holders after we adjust necessary investments to support operations, acquisitions, capital. Because remember, the fundamental value of a firm depends on its expected future cash flow. Okay, because that's how companies in the long run are valued. What is the cash flow that they can generate? We look at a very simple free cash flow, which is very common. It starts with cash flow from operations, less capital expenditures and acquisitions. Both come from the cash flow statement. And that gives us simple free cash flow. Now, this simple free cash flow can be used in many ways, but there's 5 uses. Note the 5 uses. Pay interest on debt, pay back principal on debt, pay dividends, buy back stock, and buy non-operating assets. Okay, marketable securities, etc. So the free cash flow is important to that it's a return to the investors, both the debt investors and the equity investors. So they're very clear what 5 things you can do with free cash flow. Interest on debt, principal on debt, pay dividends, buy back stock, buy non-operating assets. Think marketable securities. They're not used for the business, they're there for the future, or if they plan on an acquisition in the future. Then, that's the first one. And that one here is the one that is used most frequently when people talk about free cash flow. We then have free cash flow to equity. This is how much cash flow is available to the company's common stockholders. So in this case, that is, we start with the simple free cash flow and we eliminate the borrowing cost, principal and interest, so that we know how much free cash flow to equity is there. And again, this becomes a meaningful number, but we need to evaluate it within the context of what's happening with the firm. If a firm is growing, we're going to find they are putting a lot of money into fixed capital and working capital. So that's free cash flow to equity, what's available to the common shareholders. Now, don't forget, simple free cash flow, investors, both debt and equity. The free cash flow from operations is free cash flow for equity, from equity, for equity, cash flow from operations, less cap expenditures, plus or minus net borrowings, gives us free cash flow to equity. Here's an example of it there. The question becomes, when we look at this from an analytical, is there sufficient cash flow over time, okay, to create a long-term return for the shareholder? Because it is the cash. So as we move forward on this, once we understand the history, we're going to have to move into forecasting and then valuation. So this gives you the cash flow. Don't confuse cash flow, the ability of the firm to generate cash flow, how we do that, with liquidity. Liquidity is making sure we have enough cash to do what we need to do, where cash flow is our ability to evaluate the firm's ability to generate cash, both historically and going forward. If you have any questions, please let me know.